A very good evening, friends. So I hope you made a revision of the previous class as I requested that in terms of financial instruments, you need to do a cumulative revision. So like today after the class, you need to do a revision of the previous one and the today's class as well. So I think before we take the journey forward, we have a couple of technical things to discuss today. And I'll just like to take a quick recap of the learning so that I can do some value additions to the three-step model which I've given you. Well, our journey started in terms of financial instruments, and we said there are three broad standards dealing with financial instruments. One is the presentation, Index 32. One is recognition and measurement, that is 109. And there is a disclosure standard 107. We said a financial instrument is supposed to be a contract. A contract involves a minimum of two parties. And in terms of financial instruments, the two parties are, one is called the issuer and the other is called the holder. The issuer needs to take a decision and decide that when it issues an instrument, is it supposed to be a financial liability or is it supposed to be an equity instrument? But irrespective, the holder always says that it is supposed to be a financial asset. So whether it's an FL for the issuer, it's an FA for the holder, whether it's an equity instrument for the issuer, it is still a financial asset for the holder. So we made our clarity of thoughts that, our focus is from the issuer point of view. So we are looking at the presentation in a balance sheet where we're looking at that in the balance sheet of the issuer, is he going to reflect this as an equity instrument, which is like own funds, or is it going to be reflected as a loan fund that is a financial liability? And for this purpose, I gave you a version number 1, and then I gave you a version number 2. Today, I'm also going to give you a version number 3. But before I give you a version number 3, I just like to quickly take a recap on the version 2, because we've already, overridden the version number 1. So the version number 2, which I gave you based on a three-step model, goes like this. In order to decide whether a given instrument is supposed to be a FL or an equity instrument, and now I would say even a CFI, because we've seen that effectively from the issuer point of view, it could be an FL, it can be an EI, or maybe a blend that is called a CFI. Your focus in terms of step number 1 is that you need to see that the obligation is contractual in nature. So there has to be a contractual obligation, then only we can go to the step number 2. So what is important is that the obligation which the issuer has got is something which is by contract. So there has to be a contractual obligation. If you say a yes, we go to the step number 2. And at this stage, there is another important thing which you need to keep in mind, that when you're looking at the concept of an obligation, we've already seen that the obligation is comprising of two components. The obligation is comprising of two components. One is in terms of the return, which is in the form of interest or dividends, which you're going to pay on the instrument. And one is the repayment in terms of the principal money. So the two components are comprising of the return element, and it is in terms of the repayment of the principal money. And we also decided that, there could be a different mode of payment for each of them. But I would say even if the mode of payment is common, you still need to run this three-step model separately for each component. So it's a good idea that when you read a question, you should apply the three-step model to each and every component of this instrument. Because there might be a mandatory or a discretionary payment, let's say for a return. It could be redeemable or irredeemable, let's say for a principal. So the idea when you're looking at the two components is to make a run through of this three-step model separately. That's focus 1. Now, once you reach the conclusion, yes, it is a contractual obligation, the second focus point is on the mode of payment. So you need to focus your intentions completely that what is the mode of payment. And we said that this is an exhaustive mode of payments. To be a financial instrument, you either make your payment in cash or you make a payment in terms of equity shares. The company uses its own equity share as a currency note in order to discharge the obligation. I made it very clear that if your mode of payment is in terms of goods and service, then it is not a financial instrument. So like, for example, I receive an advance from my customer. Naturally, I have a contractual obligation, but that obligation is going to be paid in terms of goods and service and not cash or equity share. So that would be a non-financial obligation and not a financial instrument. So we said the mode of payment is typically, you can say either in terms of cash or the mode of payment could be in terms of equity shares. Now, we decided that now onwards, we're not going to say that if mode of payment is cash, you cannot say that it is supposed to be a financial liability. You also need to understand that financial liability implies that there is an unavoidable obligation to pay. And in this particular case, we decided that if you're looking at the mode of payment cash, if you're looking at the concept of a return, you need to see, is it mandatory or is it discretionary in nature? And if you say that it is mandatory, it is unavoidable in nature, it becomes a financial liability. And if it is discretionary, then it becomes an equity instrument. And then we said, similarly, when you look at the repayment of the principal component as well, so when you're looking at the repayment of the principal component, the terminology which you're going to see is either it is redeemable or it is irredeemable in nature. A redeemable instrument would indicate that there is definitely a predetermined date when you're going to pay off the money. So it's already pre-decided that you're going to make a payment at a certain number of date. So in this case, the moment it is redeemable, it becomes FL. And if it is irredeemable, then it becomes equity instrument in nature. And if you remember, I also gave you insights about a perpetual loan where I said you need to be careful. Simply, if I say that there is a mandatory interest with an irredeemable loan, you need to be careful. You may not necessarily say that it becomes a compound financial instrument. You need to consider the contracted rate and the market rate of interest and accordingly decide, is it FL or is it supposed to be a compound financial instrument? So that was one discussion which we did as a special issue. So I would say that when you're looking in terms of irredeemable perpetual debt, just remember in your mind that there was a little special issue discussion which we did. And that special issue discussion was with reference to comparing the contracted rate and the market rate in terms of perpetual loan. So that should trigger as a special issue. Then coming to the equity shares, we go on to the step number 3. We're not going to make any hurry on that. And then finally, in terms of step number 3, when you focus in terms of the number of shares, your mind starts working that the number of share is predetermined. Is it a fixed number of shares or is it a variable number of shares? If you decide to give fixed number of equity shares, then it becomes an equity instrument. And if it is supposed to be a variable number, which will be decided at a later date, then it becomes a financial liability. So that was a crux in terms of a quick mind map, in terms of what our learnings have been in the previous class. I thought before we go further, let's take a quick recap in terms of the 3-step model. So far, so good. So I think let's do one thing. Now we are in a position to add a version number 3. But before I add a version number 3, I think I want to do a little more warm-up exercise. And I want to do some one or two simple questions, illustrations, which are given in the study material, because we've understood the concept of financial liability very well. And before I go on to the third version, I would now like to take you to an illustration. So let's, I think, begin the journey. You're most welcome, Shruti. You're welcome for the revision. I thought, before we get into technical discussions, let's get a quick recap. So I'm just going to first take you to a small little illustration, which is given in rather an example, which is given in the study material. And I think just let's have a quick look at this. And I want to take you to the example and the illustration 3 both based on our learnings in the previous class itself. So this is based on the learnings what we've already done in the previous class. So I guess let's begin the journey. I am first going to do a quick revision with an example what we did. Let's now look at the example number 2 given in unit number 1 of the study material. It says evaluate whether these items are financial liability or not. It says there is a loan payable or there is a bank payable, bank loan. Well, I think in all these questions, unless mentioned otherwise, I am undoubtedly assuming that there is a mode of payment is cash. And if there is nothing given, of course, it implies it's a mandatory payment. It's an unavoidable obligation to pay cash. So when we say loans payable or a bank loan, undoubtedly it is a contractual obligation, step 1, and there is an obligation where the mode of payment is cash. And of course, I'm assuming it's an unavoidable obligation to pay. So undoubtedly it is a financial liability. Similarly, if you've got trades and other payable, bills payable and acceptance, the same logics would go. There is a contractual obligation to pay. 1, the mode of payment is cash, and we are, of course, assuming it's unavoidable obligation to pay. So therefore, in all these cases, the logic is the same. Then it says there is a deposit received. The same logic goes. It's a contractual obligation to pay cash. So whether we say there are trade payables or bills payable or a deposit received or there is a loan payable, they're all financial liabilities, contractual obligations to pay. Then it says mandatorily redeemable preference shares. I think that is again indicative contractual obligation of cash. So I think this is just to give you examples once again that these are all financial liability. And then it says, even if there is a financial guarantee, though let me tell you, not all financial guarantees would be covered under the purview of this particular standard, but let's not get into the details at the moment. So we can say that if there is a financial guarantee, it is again a contractual obligation to pay cash. And that is also supposed to be a financial liability. Though in certain cases, you might say that financial guarantee becomes contingent in nature. So can a contingent liability also be a financial liability? The answer is a yes. Even contingent liabilities can turn out to be financial liabilities as well. Okay, that was 1. Now, we had a discussion previously on a perpetual debt instruments, and I would like to draw your attention to illustration number 3. It says A issues a bond at a principal amount, which is currency unit. CU stands for currency unit, 1,000 a bond. The terms of the bond requires an annual payment in perpetuity at a stated rate of 8% on the principal amount. Now see what it says. Assuming 8% is the market rate of interest. Now you know it better. So the contracted rate of interest on this irredeemable perpetual loan is 8%, and it says assume the market rate is also 8%. So the stated rate of interest means it is the contracted rate, and we are also given the market rate is 8%. It says for the instrument, the issuer assumes a contractual obligation to make a stream of payments. Evaluate the financial instruments in the hands of the issuer and the holder. So I think let me ask you, this is a perpetual loan which has got you can say a stream of 8% contracted rate. Market rate is 8%, but otherwise irredeemable in nature. Is it FL or is it supposed to be CFI? I think let's get your answers on that. And that is wonderfully given. Yes, it is undoubtedly a financial liability from the issuer, and it is undoubtedly a financial asset from the holder's perspective. Super. Okay, that was pretty great. Absolutely correct. Warm-up exercise done. Now I am going to go on to the version number 3. So I think the warm-up exercise is done. Now let's get on to the version number 3. Now this is going to be slightly technical. So what I'm going to discuss in the next almost 45 minutes is going to be a little more intensity, but I think you need to give me a very patient listening, and you need to be very attentive in terms of every word what I speak. I know you hear me very well and you hear me with full, concentration, but I think I'm still, reiterating, I need your full concentration at the moment. Now, before I introduce you to the version number 3, I need to introduce you to the concept of derivative. Though I recall that, I had a discussion with you and I gave you some inputs about derivative earlier as well, but I'm sure many of you might be doing financial instruments maybe first time, and I don't know how comfortable you are with the concept of derivative. So do I assume that you know derivatives, or do I need to explain what a derivative is? I am assuming that I should take the liberty of at least giving you once again derivative, specifically from the point of view of understanding financial instruments better. So what do you say? Shall I do the honors or shall I assume? So you want me to give you a little insight on derivatives? Let's get a little proper understanding of derivatives, because there are certain characteristics which we need to understand, with the help of which I will be able to add on a value addition to my 3-step model. So I think let's do the journey. Let's discuss something on derivative. Let's discuss something on derivative. So first of all, let me give you the insight. I want to first of all understand from the accounting point of view that what exactly is a derivative. So let's take a very simple example, which I generally do. Let's say, for example, there is a PVR ticket. Let's say I want to buy a PVR ticket, a cinema hall ticket, and let's say this PVR ticket is available, let's say for 300 rupee. So let's say this PVR ticket is available for, let's say, INR 300. Now let's say, for example, that somebody gives me a pass, a PVR pass for the same movie. So I get a PVR pass. Now, this PVR pass generally, of course, is never transferable, but let's assume that it is written on the pass that it can be transferred. It is very clearly written on the PVR pass, for example, that it can be transferred. Now, the question arises that if this PVR pass is something which is transferable in nature, the question comes into the mind that what is the price at which you can sell this PVR pass? Now, let's assume certain things and let's get your inputs. Let's say this PVR ticket is for 300 and the movie for which you got a pass is a big hit. The tickets are not available and the tickets are not available, but you've got this PVR pass which you can give it to someone for a consideration. So would you like to tell me what is the price, the minimum price at which this PVR pass can be sold? I'll put the facts again. I'm saying the PVR ticket for the movie is a big hit. The movie is a big hit. And I have a pass for that particular movie. And since the movie is a big hit, so if I can sell this particular pass, what is the minimum price at which I can sell this particular pass at? Okay, so I think I am given something. Okay, people are telling me to say, yes, please explain some insights about derivative as well. Yes, I am doing the honors for that. So can I say what is the minimum price at which I would be able to sell this PVR pass? I think you'll agree that the minimum price at which I can sell this pass is going to be 300 or maybe 300 plus. Considering the movie is a big hit, I can say that I will be able to sell this pass at least at 300 or maybe more than that. Now, there is one important principle which arises out of this discussion. If you look at the PVR pass, its value, mind the words carefully, its value is being derived from the PVR ticket. The price of this PVR, you can say the price of this pass, the price of this pass is getting derived. It is getting derived. Therefore, we use the word derivative. It is getting derived from the PVR ticket. So we can say it is the ticket price which is acting as a base. So the pass is able to derive its value from the ticket price. In technical words, we call this PVR ticket to be, we can call this as an underlying asset. We can technically call this in financial management terms as an underlying asset. So we can say in this particular case, the pass derives its value from the ticket. When the pass derives its value from the ticket, so we can say a particular instrument which derives its value from another underlying asset is called a derivative. So in this particular case, I would say the PVR pass indirectly becomes a derivative, because a particular instrument which is going to derive its value from an underlying asset is supposed to be a derivative. It doesn't have a value on its own. It definitely gets a value, but it derives its own value from an underlying asset, and therefore it is called a derivative. So this is the basic concept of a derivative, that we need to understand that it doesn't generate its own value independently. It basically derives its value from another underlying asset. So every time you say that this derives its value from an underlying asset, I would say that this becomes a derivative in nature. Now, in terms of financial management, that when you look at derivatives, there are various kind of instruments. Like, for example, you've got options. Like, for example, you've got forward contracts. Like, for example, you've got futures. So these are certain derivative contracts. But I think I'm not too interested in discussing futures, options at this stage. I am more interested in discussing some other instruments which you've commonly heard of. But we never realize that whether they are derivative in nature or they are non-derivative in nature. So I would typically like to talk of an instrument which is called a share warrant at this stage. Maybe we can discuss options and all other things later. But at this stage, my mind is working more on the concept of a share warrant. Now, I don't know how many of you know that what is a share warrant. I don't know how many of you know that what is a share warrant, but let me explain that what exactly is a share warrant. And then I think I'll add more discussions to the concept of derivatives to you. Now, if you look at Ind AS 109, I'm not talking of 32 at the moment. When I'm explaining the concept of derivative, my focus is more on Ind AS 109. Ind AS 109 also explains us in detail that when you look at the concept of an instrument being a derivative contract, there are a total of 3 features you need to meet. I'll talk of share warrants very shortly, but I'm still coming back to the concept of derivative. The standard makes it very clear that if you call any particular instrument as a derivative contract, there are a total of 3 features which you need to meet. So let me give you the list of the features which a particular instrument should meet in order to be called as a derivative. The feature number 1 is the same which I gave you, that the value is derived. The value is derived from an underlying asset. The value is derived from an underlying asset. So this is one feature which I just gave you, that to be called as a derivative, the value of the derivative is derived from an underlying asset. That is one. The second is when you say that an instrument is derivative in nature, we need to prove that there will be a future settlement. We need to prove in this particular case that there is going to be a future settlement. So That means the instrument which you're talking of is not yet settled. It is going to be settled at a future date. And you know that when you enter into forward contracts or when you enter into options contract, they are entered as of today, but the settlement is done at a future date. So the settlement is done at a future date, though they might have been entered into as of today. And third, there is zero or we can say negligible initial investment. There is zero or we can say negligible initial investment in that instrument. So we should be able to prove that at time zero, there has been practically no initial investment. Settlement will take place at a future date, and the value of the asset is, the value of the derivative is getting derived from an underlying asset. Now, let's understand these three features with reference to an instrument, what we are calling it as a share warrant. Now, the question rises, what exactly is a share warrant? You know, many companies, what they do, they tell their existing equity shareholders of the company that we will give you something called a share warrant. And the share warrant would entitle you an option. Mind the word, it entitles you an option to buy the equity shares at a future date. So the company tells the existing shareholders of the company that we are going to give you an instrument called a share warrant, and which will give you the option to acquire, more shares. You want, you can, you don't want, you may not acquire the shares at a future date at a given price. So you tell them a price that you will be able to get these shares at a certain price at a future date. Now, let me put across these questions to myself, that if I'm looking at a share warrant, would it be able to fulfill these features or not? Number one, when a company issues a share warrant to an existing shareholder, is there any kind of initial investment or any kind of amount which the holder is going to pay to the company? No. So is there any initial investment? The answer is no. There is no initial investment. Secondly, is the share warrant going to be settled at a future date? Of course, yes. You're telling the shareholder that I am giving you the right to buy the options at a future date, the right to buy the shares at a future date. So there is undoubtedly, you can say, a future settlement as well. So I think let's not put a cross, let's put a tick. There is no initial investment and there is going to be a future settlement. Now, how does the existing equity shareholder take a decision whether he's going to buy equity shares at a future date or not? So he will look into the prices of the equity shares prevailing in the market. So when he looks into the price of the equity shares, if he knows that the price of the equity shares in the market is increasing, he is interested in exercising the warrant. So the exercise or the non-exercise of the warrant, the value of the warrant is getting derived from the equity shares itself. So I would say, yes, it derives its value from the underlying asset, that is the equity shares itself. So it fulfills all the three features. And if it fulfills all the three features, we can definitely say that share warrants is supposed to be a derivative instrument. It is supposed to be a derivative instrument. So which means, now please hear me very carefully, because I'm going to add something very, very important at this stage. And let me, I think, just consolidate this picture. So I would now say that when you look at the type of financial instruments, when you look at the types of financial instruments, I would say there are a total of 3 types of financial instruments. So I would say when you're looking at the type of financial instruments, I would say there will be 3 types of financial instruments. Till now in the previous class, my discussion was simply on deciding the instrument is FL equity. I never told you what is a tie. But today I'm adding another element. The instrument can be something what we call non-derivative in nature. The contract or the financial instrument which you enter into could be something which is pure non-derivative. Trust me, in the previous class, all the examples which I showed you were pertaining to instruments which were non-derivative in nature. Non-derivative in the sense, there is no 3 characteristics of a derivative in those instruments. The three characteristics which I gave you are supposed to be the characteristics of a derivative. And mind you, to call the instrument as a derivative instrument, all the three features need to be present. Even if a single feature is not present, we will not be able to call it as a derivative instrument. The second kind of instrument is that it is supposed to be a pure derivative instrument. Like, for example, we said a share warrant. Like, for example, we said a share warrant. So that is supposed to be a pure derivative instrument. But sometimes the instrument may have the features of both a non-derivative as well as a derivative contract as well. So it may include both a derivative and a non-derivative elements. And this is what we technically call that this is hybrid in nature. This is what we technically call is hybrid in nature. So let me put this once again. So what I'm now trying to tell you, my discussion today is being, giving you insights on a derivative because we need to understand the larger picture. And the larger picture is that when a company issues a financial instrument, it could be a pure non-derivative, or it could be a pure derivative. So it could be a pure non-derivative instrument. And my version number 2 is applicable to a non-derivative instrument, mind you. My version number 2 is applicable to a non-derivative contract so far. So therefore now what I've added that there could be a pure derivative instrument, or there could be an instrument which has got a blend of derivative and non-derivative elements, which is called hybrid. So when I'm coming to the version number 3, I'm coming to the fact that if there is an instrument which is derivative in nature, how would my 3-step model incorporate that whether it is a financial liability or it is an equity instrument? Got it? So just like a non-derivative instrument is going to be classified as FL equity, a derivative will also get classified as FL equity. And we're going to talk of this a little later. So let me now come back to the larger picture and let me consolidate the learnings. I know what we are doing is technical. I know what I'm discussing is technical, but don't worry, we'll take examples and we'll understand the logics and everything. Once the final version number 3 comes in, we'll consolidate the learnings. So, I am now coming to the concept of number 1, that what is a derivative contract? If a company issues an instrument or if a company enters into a contract as an issuer, when do you say that this contract is something which is derivative in nature? So in order to prove that it is a derivative contract, what do you need to do? You need to first of all prove the 3 features of a derivative contract. I'm going to read the question and I'm going to first of all evaluate whether it is a derivative or a non-derivative contract or a blend of derivative and a non-derivative. I put it again. When I'm going to read a question, I'm going to first make an assessment. Is it a derivative? Is it a non-derivative? Or is it a blend of derivative, non-derivative? Let's forget about the blend of derivative, non-derivative for the time being, which is a hybrid contract. Let's keep it aside. So when you're going to say that a particular instrument or a contract is derivative in nature, you got to prove all 3 conditions. You got to prove all 3 conditions in this particular case. So all these 3 features need to be present in order to call it as a derivative. The given instrument or contract derives its value from an underlying asset, 1. The settlement of that contract is going to take place at a future date, 2. And at the initial, there has been negligible or no investment at the inception, there is 3. So if you can prove that there is no investment or negligible investment at inception, if you can prove that yes, settlement is at a future date and the value of that particular instrument or contract gets derived from another underlying asset, then I can say it is a pure derivative in nature. And I proved that a share warrant is supposed to be a pure derivative in nature, right? So I hope I'm very clear, friends, at this stage, right? Okay, I guess, Shankar sir, we'll never ever forget the concept of derivatives in our life, especially with the PVR example. That's wonderful. Shruti sir, wow, so never heard this type of explanation for derivative. Okay, that's wonderful indeed. So I think my job gets done at that. So this is the three features you need to understand and then accordingly decide it is a derivative. So this is phase one. So what I've taught you before a version 3 is how to decide an instrument is a derivative instrument or not. You fulfill these three features, it is derivative. You fail any one, it is non-derivative. Let's not talk about a blended instrument. Let's not talk of a hybrid instrument at the moment. Now, I think it's time to give you a version number 3. We're ready to give you a version number 3. So let's, I think, make a documentation on the 3-step model. I'm giving you the 3-step model, and we're working now on the version number 3. So I'm working on the version number 3. So let's put it 3.0. So this version is the final version which will override what I gave you in terms of version 2. So now onwards, every time you do a question, now you will tell me, sir, we want to make a revisit on the questions which we did last class, because now we want to see the things with a complete perception of a version 3. Is it derivative? Is it non-derivative? Whatever. Nobody, we're going to do that as well. So in terms of the version number 3, when I come to the step number 1, no change. The step number 1, which I gave you in the version 1 and the version 2 is the same. So it is same as version 2. It is same as the version number 2. No changes in terms of the step 1. The parameters remain the same, that you need to run the 3-step model for the return component separately, for the principal component separately, everything remains. Then we come to the step number 2, and in terms of the step number 2, it is again same as version 2. So, but you said that you need to now start looking at the contract is derivative or non-derivative. Now, please hear this carefully. In the step number 2, you focus on the mode of payment being either cash or the mode of payment is being either equity shares. If the mode of payment is cash, it does not make a difference to me whether it's a derivative or it's a non-derivative contract. When the mode of payment is cash, it would not make a difference to me whether a particular contract is a derivative or a non-derivative, which means my assessment whether a particular contract is derivative or non-derivative is required only if the mode of payment is equity shares. So I'm going to basically change the step number 3. So when you read a question, there is no need to immediately start thinking, whether it is a derivative or non-derivative. Watch out that if the mode of payment is supposed to be cash, I don't need to decide whether it is derivative, non-derivative. Here the focus is mandatory, discretionary, redeemable, irredeemable. That's it. No derivative, no non-derivative required. Now comes the step number 3. So when you say the mode of payment is supposed to be equity shares, now we need to be careful and we need to decide that is it derivative or is it non-derivative. So don't worry, I'll first document the inputs, then I'll explain the logics as well. Don't get worried on that. So the moment you go to the step number 3, and you say the mode of payment is equity shares, you need to decide, is it a non-derivative contract or is it a derivative contract? So at this stage, you need to decide that is it derivative or is it non-derivative in nature. So it is only if the mode of payment is equity shares, you need to take a decision whether it is derivative or it is non-derivative in nature. Last time I gave you that you need to see the number of shares being fixed or variable in number. This is technically called a fixed test. So if it is non-derivative, you are going to conduct what we call a fixed test. So if it is non-derivative, you are going to conduct what is called a fixed test. In this fixed test, you just need to see is the number of shares fixed or not. So in the fixed test, you're just going to see is the number of shares to be issued fixed or not. So when I apply the fixed test, the focus is to see is the number of shares to be issued fixed or variable. If the number of shares to be issued is fixed, then it was equity instrument. And if the number of shares was variable, it was supposed to be FL. That stands. That stands exactly similar to what we did earlier. That stands absolutely similar to what we did earlier. So if I say that the number of shares to be issued is fixed, it is equity. And if it is variable, then it is FL. If the contract is derivative in nature, you cannot apply the fixed test. There is a new test to be applied if it is a derivative contract, and that is called a fixed for a fixed test. It is called a fixed for a fixed test. The test itself undergoes a change. If it is a derivative contract, you need to apply a new test altogether, and that is called a fixed for a fixed test. Now, don't get worried on what is this fixed for fixed test. I'll be explaining that as well. But when you look at the concept of a fixed for a fixed test, there are two elements which are fixed to be checked. There are two elements to be checked in this case. It says fixed for a fixed test. So what we're going to do, we are going to see is the consideration fixed. We're going to see that is the consideration fixed, and we're going to see is the number of shares to be issued fixed. So when it is a derivative contract, you need to see, what do you need to see as an issuer? You need to see the consideration you will get. The consideration you will get and the number of shares you will issue against that consideration. So you need to see the consideration you get and the number of shares you will issue against that consideration. Both need to be fixed. So in this particular case, if both of them are supposed to be fixed in nature, then it is going to be an equity instrument. If the consideration received and the number of shares to be issued against the consideration is fixed. So what the company gets as a consideration and what the company issues as a number against that consideration is fixed, it is equity. But if any one is variable, if any one or both are variable, if any one or both are variable, it becomes a financial liability. So once again, this is getting technical. Don't worry, I'll give you the logic as well, but let's first get the concept, what you need to check, and then we'll understand the concept as well. Don't worry. I'll give you the complete logic as well. The only portion which I've added is in step number 3, this element. So let me, I think, consolidate first what do you need to think, and then I'll give you the logic as well. No worries on that. Okay, Shruti said, sir, why are we applying a fixed test? Why not the 3 features? They're not sufficient. No. Let me explain. You see, to decide whether the instrument is derivative or not, you apply the 3 features. But to decide that the derivative instrument is FL or equity, you apply this test. You know, there are 2 different things in life. You are deciding is it derivative or not. To decide the contract or instrument is derivative or not, you apply the 3 features. Once you apply the 3 features, you say, yes, it is derivative. No, it is not derivative. But then the idea is then to decide further that is it FL or is it equity. So these tests, that is a fixed for a fixed test or a fixed test, is to decide FL equity. And the 3 features is to decide derivative, non-derivative. So when you decide derivative, non-derivative, 3 feature. When you decide non-derivative, FL equity fixed test. Derivative, FL equity fixed for a fixed test. I hope I'm very, very clear on my thoughts. Now, coming back to the agenda, let me put it further out here. So once you apply the three features and you're able to zero down that the instrument is non-derivative or derivative in nature, then you decide, okay, if it is non-derivative, let me apply the fixed test. The number of shares to be issued is fixed or variable, and accordingly we decide FL equity. But if it is a derivative contract, you need to apply fixed for a fixed test. So there are two things to be seen which needs to be fixed to call it as equity instrument. The consideration to be received is fixed. The number of shares to be issued against that consideration is fixed. So if the consideration to be received and the number of shares to be issued both are fixed, it is equity. If any one or both are variable, the consideration is variable, the other may be fixed. The number is variable, the consideration may be fixed, or both are variable, it becomes financial liability to that extent. So can you now please give us a logic of why are you applying a fixed test for a non-derivative and a fixed test for a derivative in nature? I'll do that now. Let me illustrate that part now further. I need your input, friends, on this, and watch this carefully. You know this, but I think once I say this, then it'll start clicking. Oh yes, I didn't think of this. Now, let me, I think, give you a little logic in terms of this. Just have a little quick logic on this. So I'm looking at two elements. I'm looking at the fact about consideration. I'm looking at the fact about consideration. I'm looking at the fact about number. And I'm looking at the instrument which is non-derivative in nature. And I'm looking at the derivative contract. Now watch this carefully. You'll get a logic very simple. What is the logic of a fixed test and a fixed for a fixed test? Now, when you say it is a derivative contract, like for example, it is a share warrant. Now imagine that I'm looking at a derivative contract, which is like a share warrant. Now my question is, a company issued a share warrant to a shareholder, which is going to be exercised at a future date. So when will the company get a consideration? Has it already got a consideration, or is it yet to get a consideration? Sir, it is yet to get a consideration. So the consideration in terms of a share warrant is yet to be received. The consideration for a share warrant is yet to be received. And when the company will be getting money against the share warrant, then it will be issuing shares at a future date. Could be fixed or variable in number. So the number of shares to be given is also yet to be given in the future. So the consideration will be received rather than saying yet to be received. Let's say, is it relating to the future? Yes, it relates to future. Yes, it relates to future. So you can say that in case of a derivative contract, the consideration will be received at a future date and the number of shares will be issued against that consideration at a future date. So both the consideration and the number relates to the future. If both of them relates to the future, we are applying a test called fixed for a fixed test. The consideration to be received is futuristic. The number of shares to be issued against the consideration is futuristic. So we're looking at both the futuristic factors, that the consideration fixed, the number is fixed. It is called fixed for a fixed test. Now, on the other hand, let's look at a non-derivative instrument like we saw in the previous class. A company issued debentures which are going to be converted to equity shares at a future. So when the company issued debentures, did they already receive a consideration? Oh, yes. Can I say the consideration is already received in the past? But the number of shares to be issued against that consideration is going to be done in the future. So the shares will be issued in the future. The consideration is already received as of today. So what relates to the future is only the number, and therefore it is called the fixed test. I hope you're getting the logic. Because in terms of a non-derivative contract, the company that is the issuer has already received a consideration, and it is only the number which relates to the future. So the focus is only on the number, and therefore it is called the fixed test. But when the company is looking at a derivative instrument, the consideration will be received in the future, the shares will be settled in the future. So everything, the consideration number, both relates to the future. Therefore, the standard setters decided to look at a test called fixed for a fixed test. Did I make sense, friends? Are you able to get the logics on that? Okay, and I guess we're getting more questions, Shruti. So why fixed is equity and for variable it is FL? Well, I gave you the logic in the last class. And I said you need to look at things from the risk perception. And I told you that if you go to issue a fixed number of shares, you pass on the risk to the holder. And if you pass the risk on the holder, any instrument which passes the risk on the holder is equity. And if it is a variable in number, then the risk is on the issuer, because I'll give you as many shares so that I pay you your money back. The risk is on me. When the risk is on the issuer, it becomes an FL. When the risk is on the holder, it becomes an equity. And therefore, whenever we are saying that everything is fixed, it is equity. But even one is variable, then we're going to call it as an equity instrument in terms of derivative. Right? Okay. Okay, so I hope you got the picture. So let me now consolidate and take it further. I know what we're speaking is quite technical indeed, but if you want to get a good grip on the financial instrument standard, you need to understand the technicalities as well. So moral of the story, let's, I think, consolidate the three-step model, version 3, and we can do a practical question with you on this area. So I'm working on the simple concept. I'm working on a simple concept, and that is, you need to put across a question, is there a contractual obligation? I said yes. You go to the mode of payment, and if the mode of payment is either cash, if it is cash, I'm not worried on its derivative or non-derivative in nature. Because if the mode of payment is cash, I'm not worried on derivative, non-derivative. The standard does not make a distinction. The standard does not make a distinction in terms of that if the mode of payment is cash, you start looking into derivative or non-derivative. You start need to looking into derivative, non-derivative only if the mode of payment is equity share. One focus. And once you see that the mode of payment is equity share, now you need to decide the nature of the contract. Is it non-derivative or is it derivative in nature? You decide things with the three features. If the three features are present, it is derivative. If any one feature is missing, it is non-derivative. Decide with the help of three features, is it derivative or non-derivative? If it is derivative, you need to apply a fixed for a fixed test. And if it is non-derivative, you need to apply a fixed test. In a fixed test, the focus is just the number. In a fixed for fixed test, the focus is on the consideration to be received, vis-a-vis the number of shares to be issued. And if both are fixed, it is EI, otherwise it is FL in any other permutation combination. Right, friends, I hope I am conceptually clear with the thoughts. Okay. Great. And Kriti, you said, so if the holder decides not to exercise a derivative option, then, well, I think let me again remind you, in this 109, we're going to get into the accounting treatment. At the moment, we are on the presentation, so we're not going to talk on the accounting aspect as of now, except I will be discussing compound financial instruments in more detail triggering today, and then I'll give you a lot of plethora of, permutations, combinations on a compound financial instruments. Okay. I think now let's go to a question with you. With all okay. I think I am now ready in terms of deciding a few things. Okay. Let's now have a look at this, and we are going to consider our three-step model. So I'm now going to look at questions. Rather, let me do one thing. Let me just take you back on the questions which we did yesterday as well. So we can just have a quick look at the questions. We can have a quick look at the questions and we can decide our three-step model. So coming to few questions once again, some of the questions would be overlapping with our discussions in the previous class as well. This is just to get the concepts very clear. I'm looking at the unit number 3. This is a question in unit number 3, illustration 1. It says A issues preference shares. I'm given that A issues preference shares, and the preference shares are redeemable at the end of 10 years from the date of issue, and they entitled to a cumulative dividend of 15%. And the rate of dividend is commensurate with the credit risk profile of the issuer. I want to say a few things. Please hear the words very carefully. Well, I think in this particular instrument, do you get any sense that the mode of payment is equity shares? Just look at what I tell you, nothing more, nothing less. He says they're redeemable and there is going to be a dividend. So one thing is very clear, that the mode of payment is supposed to be cash. And if the mode of payment is cash, I don't care whether it is derivative or non-derivative in nature. My parameters which were there discussed in the previous class goes absolutely well. Please mind every word of what I say. So in this particular case, the mode of payment is cash. And when the mode of payment is cash, my focus is only mandatory, discretionary, redeemable, irredeemable. That's it. So in this particular case, I know it is redeemable FL. The dividend is cumulative FL. So we know that both the elements are FL, and if both the elements are FL, the instrument is undoubtedly FL. I wanted to make a revisit on this illustration, because now you need to be clear that since the mode of payment is cash, I'm not worried on the fact that it is supposed to be derivative or non-derivative in nature. Let's go further. Then we saw a couple of more questions coming in, and I think let's have a look at illustration number 2 and illustration number 3 as well. So let's look at the illustration number 2, which we saw the last time as well. Company issues debentures to Y company and they are redeemable. From 10 years from the date of issue, interest is at the discretion of the issuer. The rate of interest is commensurate with the risk profile of the issuer. And let me also pinpoint, when I say that the rate of interest is commensurate with the risk profile of the issuer, it means that the contracted rate and the market rate is same. And if the contracted rate and market rate is same, then I think it definitely does not, contain any kind of CFI elements as well. So in this case also, I think I'm very clear. In this case, I am nowhere given that there is any kind of equity shares being used. So the mode of payment is undoubtedly cash. And the mode of payment is undoubtedly cash. I think my status of the previous analysis continues. My focus being cash, I just look at one thing, that it is supposed to be discretionary, mandatory, redeemable, irredeemable. So I know it is redeemable FL, discretionary EI. So if it is FL plus EI, the instrument becomes a compound financial instruments in this case. Let's go to the next one and let's look at the illustration 3. It says the company took a loan from Q. The loan is perpetual and it entitles to a fixed interest. I think the mode of payment again is cash. Nowhere I am given in the question that the mode of payment involves any kind of equity shares. So if the mode of payment is cash, I think derivative, non-derivative is not at the back of the mind. But I told you that in such kind of illustrations where there is a mandatory interest and it is irredeemable perpetual loan, your focus should immediately turn to whether the contracted rate and market rate is same or not. And that special issue discussions we have already done. So considering that if the contracted rate and market rate is same, it is FL, and if the contracted rate is less than the market rate, then it becomes a compound financial instrument. So, sir, what do we tell the examiner? If you remember, at the beginning itself, I did an illustration number 3, and in that illustration number 3, the same question was there, and it very clearly said, assume that 8% is the market rate of interest, which proves my point that if the CR, contracted rate, and market rate is same, it is FL. But if the contracted rate is less as compared to market rate, it gives rise to a compound financial instrument. Fourth illustration was just a clarification which I gave you, that if you've got an inability to pay, if there are restrictions on transfer of, let's say, foreign exchange, your inability to pay or restrictions on you cannot undermine your contractual obligations to pay. An instrument which is FL remains FL even if you've got inability to pay. So that was illustration 4. Let's now go further. And this is a beautiful, beautiful, beautiful illustration. Illustration number 5 is beautiful. Now you need to watch this very carefully. Okay, I think I'm getting some more questions as well. So this example is done in the previous class itself. You're right. You're absolutely right. But I said I'm running it through for safety reasons, because I said last time you did not know derivative, non-derivative, not to leave any stone unturned. Shridhar, kindly help me to clear one thing in equity. First, we say if it is derivative or non-derivative, then again fixed or fixed for fixed test to classify whether it is equity. Yes. Let me put it once again. If the mode of payment is cash, the focus is mandatory, discretionary, redeemable, irredeemable. No derivative, non-derivative question. If the mode of payment is equity share, 2 questions. First, derivative or non-derivative. Apply the 3 tests and see derivative, non-derivative, and then accordingly decide, do we apply fixed test or do we apply fixed for fixed test, and accordingly decide FLEI. So when you get mode of payment cash, the focus is only mandatory, discretionary, redeemable, irredeemable. No derivative, non-derivative. If the mode of payment is equity shares, in those particular cases, derivative, non-derivative, step 1, and then fixed test or fixed for fixed test to decide FL or AI. Correct? Okay, I think Kriti, you said in example number 2, contracted rate, market rate affects the decisions. Yes, the example we did. Then the question is, illustration 2, the contracted rate assumed to be market rate. Yes, if you say it is different, I've already explained, then in that case, it becomes a CFI. Okay. Now let's go further. Now this is interesting. It says optionally convertible preference share. Now friends, I'm not going to solve this illustration, but I want to definitely make you very clear, and we'll discuss very shortly after a little while on this kind of instruments as well. You give an instrument to the holder and you give him an option to convert. Option, thy name is derivative. Option means that you're giving a choice, and this choice is available in the future. So if you put an option within a contract, it is an indicative that there is a derivative within the contract. But we are not saying it's a pure derivative. It's an instrument which is derivative plus non-derivative combined. If you remember my discussion, I said the instrument can be either a pure non-derivative, or it is a pure derivative, or it is a hybrid instrument. So if a company issues optionally convertible preference shares, optionally convertible debenture, trust me, it's hybrid contract. It's going to be a hybrid contract. So there has not been much deeper discussions made on this at the moment. So we're keeping this pending. We'll be coming to this, but you can see in the section of compound instruments, we will analyze the other component, the conversion option with the holder, and explain the nature of instrument in entirety. So we'll be discussing that illustration, but this is hybrid in nature. This is a hybrid contract. It's a blend of a non-derivative and a derivative, which I'm going to very shortly discuss. But I'm keeping it pending for the time being. Okay, I'm not coming to illustration 5. So this is a couple of questions which we did in the previous class with you. So now let's go further. I'm coming back to the unit number 1. Let's come to the unit number 1. Let's see if we can do any question at this stage from unit 1. There is one more question which we'll see, but I think let's have a look at this question. So let's have a look at this particular question. Okay, so these were two more illustrations, 7 and 8, which I took you. Let's now go with this. Let's go with illustration 6, 7, 8, unit 1. Illustration 6, 7, 8, unit 1. Then I'll show you one question of mine, which is, I think, somewhere given in the study mat, but I think maybe I just need to locate that. Let's have a look now at illustration 6. Silver issued irredeemable. It issued irredeemable preference shares with a face value 10 at a premium of 90, and they carry a dividend 8%. However, dividend is paid only when it declares a dividend on equity share. Am I given anywhere the mode of payment is equity shares? No. If I'm not given the mode of payment is equity shares, that means the mode of payment is supposed to be cash. And in this case, I'm not concerned whether it is derivative or non-derivative in nature. We've been smart and we have done questions only to the extent the concept learned. But it is important that you go back and have a look at those questions with the final version number 3, which is given to you. So in this particular case, considering that it is irredeemable, that's equity instrument. Dividend is paid only when you pay the equity share, makes it discretionary. So we can say both the components are equity instrument. The instrument is equity in nature. So that was done. And then we've got illustration 7 and illustration number 8. Illustration 7 and illustration number 8. Let's have a look at illustration 7. It says A invested in compulsorily convertible. It's not optionally convertible. It is compulsorily convertible in nature. If there is an option to convert, it gives rise to a derivative element in a non-derivative contract. Mind the words. If there is an option to convert in an instrument, the option to convert will give rise to a derivative element within a non-derivative contract. It's hybrid. But if you say that it is compulsorily convertible into, shares, compulsory convertible means it's non-derivative in nature. A mandatory conversion, a compulsory conversion would keep the instrument non-derivative in nature. It says A invest in compulsorily convertible shares. Under the terms of the instrument, each share is convertible into one equity share at the end of 5 years, and they carry dividend 12% declared at the discretion of B. In this particular case, is the mode of payment equity shares as well? Yes. In this case, the mode of payment for the dividend is supposed to be cash, but the mode of payment for the principal component is equity share. And if it is equity share, do we need to take a decision that it is derivative or non-derivative in nature? Yes. So in this particular case, we can clearly say that since it is compulsorily convertible, we would consider this to be non-derivative in nature. And if it is non-derivative in nature, then which test are you going to apply? We are going to apply the fixed test. And we are only going to see that was the number to be issued fixed or not. And it very clearly says each CCPS is convertible into one equity share. So the number of shares to be issued is going to be fixed in number. That's what it says. The conversion into fixed number of equity share, and there is a non-cumulative dividend. So this means in this particular case, we can say that one of the element is equity and the other one is a discretionary. It is equity. The overall instrument becomes equity in nature. So the definition of equity instrument will be done. I think this is the only illustration we have seen, which we saw in the previous class, where the mode of payment is equity shares, but if it is mandatory or it is compulsorily convertible, it's non-derivative in nature, and therefore the fixed test would apply. The fixed test would become applicable in this case. Let's have a look at a further one as well. I think we saw this one as well. Illustration number 8, target took a borrowing. It entered into an arrangement for settlement of loan against certain number of equity share. They have already entered into an arrangement where the conversion of the loan will on a mandatory basis take place into equity share. If it is going to be mandatory in terms of equity share, if it is going to be mandatory in terms of equity shares, then in this particular case, just a second, got stuck up, I guess. This was too heavy for the system to actually take. I don't know whether the savings have taken place or not in this case, or everything gone. Oh my God. Just give me a second. Let me see if this has got saved or not. Oh, bad luck. I guess this was not saved. I guess bad luck. So I think all my notes have gone. No worry. I think I'll just make a quick inputs on that. So it could not get saved, I believe. My God. This was too heavy current on the minds, I guess. Okay, not an issue. Not an issue. So I think we were discussing the illustration number 8. And in terms of illustration 8, I was again telling you that this is a case of a non-derivative contract. And I think it's been a clear-cut mention as well, very clearly, which is stated out here, that in this case, it is a non-derivative contract, and therefore a fixed test is applicable. So let me now do a consolidation. I can take you to one simple little question as well. Okay, I think that's thanks Shruti on that. So I think so far all the questions got answered so far. Now, I think let me now give you a question further based on a learnings, and then we can just consolidate the quick learnings and then go to the next phase of discussion. I am carrying a few examples which I inserted, picked up from the study material only, but there is one particular question which I thought I might not miss. So I am just going to take you to a particular question, which is question number 4. So I'm looking at the question number 4. Let's have a look at the question number 4 on the screen. This is one of the questions in the study mat itself, but maybe I think we missed that particular illustration. So let's have a look. It says A issues warrants to all the existing shareholders, entitling them to purchase additional equity shares of A with a face value 100 at a price of 150 per share. Evaluate whether this constitutes an equity instrument or a financial liability. Now, let's get the focus clear. Let's apply a 3-step model before we go further. Please watch this analysis carefully. It says A issues a warrants to all the shareholders, entitling them to purchase additional equity share. So I'm going to first of all go to the step number 1, that is there a contractual obligation of A? I would say yes, there is a contractual obligation. I go to the step number 2 and I see the mode of payment, and the mode of payment is equity shares. The moment I see the mode of payment is equity shares, I go to the step number 3 and I need to decide that is it derivative or non-derivative in nature. So I go to the step number 3 and I decide, is it derivative or non-derivative in nature? So what do? I apply the 3 features. And I apply the feature number 1, that is this share warrant supposed to be, number 1, going to be settled in the future? Yes. And is there any initial investment? No, there is no initial investment. And number 3, does the value of this warrant depends upon the value of the equity shares? Yes. Once the 3 features are met, I say it's a pure derivative in nature. And if it is a pure derivative, then I need to apply the fixed for a fixed test, which means I need to consider that what is the consideration I will get and what is the number of shares I will issue. So in this particular case, if I consider the number as well as the consideration, it says 150 per share. It says A issued a warrants to all the shareholders and told them that you will be paying me 150 per share. So is the consideration to be received fixed? 150. Is the number to be issued against the consideration fixed? Per share. The consideration is fixed. The number is fixed. The company will get a fixed consideration 150 against one share to be issued. The number is fixed. The fixed for fixed test is passed, and therefore it becomes an equity instrument to that extent. I hope now I'm very clear on the agenda. Though I am not yet done any discussions on hybrid, but I think let me now consolidate the positions and give you the crux in terms of the three-step model, where now you can practice any kind of questions in the unit number 1 or in the unit number 3 on the classifications as either FL or either CFI or EQT, whatever the case might be. Then we'll discuss the hybrid instruments as well. So let's, I think, put the picture once again consolidated to you. So let's put this consolidated picture before we go on to the hybrid contract discussions. So let me just put this in a go, so that all the clarification stands out here. So let's, I think, consolidate the picture. So we are giving the final version with some detailed inputs which we might have missed out in the version 3. So let's give you the final version of how the thought processes to be applied at each stage. I'm going to go on the focus on step number 1, where the focus is the obligation. The focus is the obligation contractual in nature? Is the obligation contractual in nature? Circle the word contractual. So the focus is very clear, that is the obligation contractual in nature? So the answer is a yes or a no. The answer is either a yes or the answer is a no. If the answer is no, we know the standard is not applicable. And if the answer is a yes, we need to go to the step number 2. So your first focus is simply to check the contractual obligation. That as an issuer, do you have an obligation which is contractual in nature? Then you go to the focus in terms of the step number 2, and in terms of step 2, you focus on the mode of payment. And when we focus on the mode of payment, the focus is either it's cash or it is equity shares. And I think now we know this very well. So I think let's put it point blank, that if the mode of payment is cash, I am not concerned whether it is derivative or non-derivative in nature. You need to be very clear that the moment the focus is cash, I am not concerned. I am not even interested in finding out that it is derivative or non-derivative. My focus is merely whether it is mandatory or discretionary in terms of return, or it is redeemable or irredeemable for the principal component. And along with this, my focus is also on the issue, especially when you're looking at perpetual loans. Especially when you're looking at perpetual loans, your focus has to be on the contracted rate versus the market rate. So you know that if the mode of payment is cash, I'm not bothered on derivative, non-derivative. The focus is mandatory, discretionary, redeemable, irredeemable, and on the special point, perpetual loan. And if the mode of payment is equity shares, you go to step 3. So this is the input in terms of step 2. So now we know that the first focus is obligation contractual. Second focus, mode of payment. When cash is the mode of payment, your focus needs to be very clear. Where do you see what terms? And if there is perpetual, your comparison on CRMR. Then finally, we go to the step number 3. And when we go to the step number 3, where the mode of payment is equity shares, when the mode of payment is equity share, now your concern, we need to watch out that it is derivative or non-derivative in nature. So before you do anything, what you need to do, first of all, you need to decide it is derivative or not. So you need to decide on the nature of contract. You need to decide on the nature of the contract or the financial instrument. Is it non-derivative in nature? Is it non-derivative in nature, or is it derivative in nature? So first thing before you apply the test is to decide, is it derivative or is it non-derivative? And when you decide it is derivative or non-derivative, you need to see that all 3 features are present. We need to see that all 3 features are present to call it as a derivative instrument. And you know the 3 features. The 3 features is that the value depends upon an underlying asset. The value depends upon an underlying asset. Number 2, there is no initial investments. And number 3, there is going to be a future settlements. So this is the 3 parameters which will decide it is derivative or non-derivative nature. You meet all the 3, it is derivative. You meet fail any one, it is non-derivative. So all 3 are present, it is derivative. And if you say any one fails, or more than one fails, it is non-derivative in nature. And thereafter, once you've decided it is non-derivative, you need to apply a fixed test. And once you decide it is a derivative, you need to apply a fixed for a fixed test. So the moment you decide that it is non-derivative, you apply a fixed test. And the moment it is derivative, you apply a fixed for a fixed test. This is to decide equity or F. So here you see the number. And if the number is fixed, it is equity. And if the number is variable, it is FN. The focus is just on the number. But if it is fixed for a fixed test, the focus is on the consideration and the number. The focus is on the consideration and the number. Both are fixed. So if we say both are fixed in nature, if both are fixed, it is supposed to be equity instrument. And if any one or both variable, in nature, any one or both are variable, then it becomes FL. So this is the crux in terms of our entire discussions. Our concentrations has been on pure ND, non-derivative, pure D, pure derivative instruments, but not hybrid so far. Okay, so far so good. I want you friends now to give yourself a comfort zone on a scale of 10 based on the final version of the 3-step model, that your focus in terms of cash, not concerned derivative, non-derivative, but only mandatory, discretionary, redeemable, irredeemable with the special issue CRMR. When it is supposed to be equity share, the focus derivative, non-derivative, and accordingly fixed and fixed for fixed test, and you decide accordingly things. So let's get your comfort zones on a scale of 10 on this. Okay, I think Kriti, you said, sir, it is the mode of payment against equity shares or the option to purchase additional shares. Well, the mode of payment is when you're looking at the fixed for a fixed test is we're looking at the consideration which will be received and the number of shares which will be issued at a later date. Okay, I think Chakrapani, you said, so can you explain that question number 4 again? It's the number of shares which are fixed. I'll explain that question number 4 once again. Okay, we got the scores 89.2, 888. That's pretty good. Okay, let me explain that question number 4 once again to you. The share warrants question. Let's go back to the share warrant question once again. Well, in this particular case, you can notice that A issued warrants to the existing shareholder. Now, we've already seen that the share warrants will fulfill all the 3 features of a derivative instrument. So this is undoubtedly a derivative instrument where the mode of payment is equity share. That's one thing. Now, when it says that the additional shares will be issued at 150 per share, look at the words 150 and look at the word per share. As a issuer company, when I will issue equity share, what is the consideration I will get? 150. Is that fixed? Yes. What is the number of shares I will issue against the consideration? 1 share, right? I will issue 1 share. I told the person, you give me 150, I give you 1 share against 150. So is the consideration fixed? Yes. 150. Is the number to be issued against that 150 fixed? Yes. If the number and the consideration is fixed, it becomes an equity instrument to that extent. Right? I guess you got your answer on that. Okay, so that's great. Bill has got a score 10 by 10. Yadu has got 9 by 10. That's pretty good, interesting indeed. Okay, now this part is done. Now I'm going to go to the next area of discussion. So I've given you the inputs in terms of the standard. How do you decide with the version number 3 that it is equity, FL or CFI, whether it's derivative, whether it's non-derivative? Now I think I need to take you further to the next level of discussion, and that is considering hybrid contracts. Now, friends, watch me carefully, but I think maybe we can discuss the hybrid later. But I think at this stage, let's go to another part, because the understanding of hybrid instruments would require a bit of the understanding on a compound financial instruments as well. So let's, I think, keep that discussion of hybrid again a little pending. Let's now go further. So I'm now going to take you further and also give you another basic insight with an example to understand this more clear. I'm just telling you something more which will only clarify and only, clear the concepts further. So let's give you a little lighter story. And this lighter story is going to give you some good insights. I'm going to now tell you a little story about 3 people, so that your fundamentals becomes more clear in nature. So let's give you a story about Mr. A. Let's give you a story about Mr. B, and let's give you a story about Mr. C. Okay, so I think let's do the storytelling to you. I'm going to give you storytelling about 3 people, and then I'm going to put some questions to you so that I'm created my base on that. Let's say this is Mr. A. My drawing may not be very good indeed, but just have a look at the story, not the drawing. This is just to make it a little more interesting and lighter for the day. Now, let's say this is Mr. A, and let's say this is Mr. B, and let's say this is Mr. C. So that I can take you to that optionally convertible part as well. So let's have a look at this particular part now. Now, Mr. A goes to the company and says that I want to invest 10 lakhs into your company. Mr. A approaches a company and says that I am interested in investing 10 lakhs in your company. The company puts him a question, would you like to take a risk? The company said, would you like to take a risk? And he says a big no. He says, no, I'm not willing to take a risk. He says, I want interest for the next 5 years at market rate of interest. And I want my principal money back after 5 years. His terms are very clear. He says, I want interest at market terms. So you will enter into a contracted rate, which is equal to the market rate. And you're going to give me my principal money back after a period of 5 years. So he makes a deal with the company that I'll give you this money, you pay me interest at 10% market rate and the principal money back at the end of 5 years. What do you think is the kind of instrument the company will issue to Mr. A? Is it going to be FL? Is it going to be EI? Or is it going to be something else? Let's get your viewpoints on that. So what do you say in this particular case? In this particular case, what is the kind of instrument the company will issue Mr. A, considering the terms between the company and Mr. A? That's rightly said. It is undoubtedly going to be a financial liability for the issuer. The risk is taken completely by the company and not by the holder. So it's a pure financial liability. Great. Let's go to the next example. Let's consider now Mr. B. Mr. B puts the same condition to the company that I am going to invest 10 lakhs into your company. And the company puts him the same question that do you want to take a risk? And he says, yes, I am definitely willing to take a risk. So the company says that we will not pay you any contractual interest or dividends, and we will not pay you money unless the company liquidates. So they clearly tell him, the company clearly tells him that, boss, since you're willing to take a risk, let us tell you one thing, that you give us this money, we are not contractually obliged to give you any interest or dividends, and you will not get your money back after a certain number of years. Only if the company liquidates, we will be giving your money back. And that also if anything is left. So what do you think, what kind of instrument would the company issue to Mr. B? What is the kind of instrument the company will issue to Mr. B considering the terms and conditions of the arrangement? So in this particular case, he is taking a complete risk level, and that's rightly said. It is undoubtedly going to be equity instrument. Beautiful. Wonderful indeed. So that was correct. Now let's go to Mr. C and let's find out the picture. Mr. C also tells the company the same thing, that I am interested in investing 10 lakhs into your company. And the company puts the same question to him, that in this particular case, are you willing to take a risk? He says, I will take a risk, but a little calculated risk. I'm not willing to take, a huge level of risk. He says, I'm not like Mr. A, who's not willing to take a risk. I'm not like Mr. B, who's going to take a complete level of risk. I've got a moderate approach in life. I will take a calculated risk. Now, what the company tells him, please hear this carefully. Please hear this carefully. The company tells him that, okay, Mr. A, we gave him a 10% interest, which is a market rate. And we told him that we will repay your money in cash at the end of 5 years. But to you, we will give you an option to convert. We'll give you an option to convert. So in this particular case, if I give you an option to convert, but let me tell you, if I'm going to give you an option to convert, you've got a choice of taking a cash, or you've got a choice of taking equity shares. You've got a choice. Now, since you're going to get a choice, you can't get your bread buttered on both the sides and eat it too. So we're going to give you a rate of interest 8% instead of 10%, what we gave to Mr. A. So now let me ask you, from the risk point of view, what do you think in this particular case? Is Mr. C also bearing a risk along with the company? The company on a non-convertible instrument, the company on a non-convertible instrument is going to pay a 10% rate of interest, but on a convertible instrument, it is saying we're going to give you only 8%. So what kind of instrument do you think on a logical level will the company give this fellow, considering that he is getting 8% instead of 10%? Let's get your results. This fellow is somewhere in between Mr. A and B, and he says, I will take an option to convert, but he's getting a lesser interest as compared to the market rate of interest. Naturally, the company would generally never pay the same interest to a fellow who gets a non-convertible option and who gets an option to convert. So what do you think? What kind of instruments would you issue? I'm yet to get answers on that. So let's eagerly waiting for your inputs on this particular part. because I think that's the only interesting agenda to be seen. And that's rightly said, very good. The company is going to give them a compound financial instruments. That's wonderful indeed. Okay, I think I just got one input from Shruti on that. Many people are feeling a little apprehensive in terms of saying that C is going to be given a compound financial instruments. Now, you would understand one thing very clear, that in this particular case, you are not paying him according to the market terms, you're paying him a little less. And trust me, if you're going to pay him a little less, the risk is getting divided. If you look at from the risk perception, here the risk is only on the company. Here the risk is only on Mr. B. But here the risk not equally, but is got divided in terms of the company and Mr. C. So an instrument which is a pure equity, risk is on the holder. An instrument which is a pure FL, the risk is supposed to be on the issuer. And an instrument which is a compound financial instrument, the risk gets spread between the holder as well as the issuer. And we are definitely assuming that in this particular case, if the instrument is got an option to convert, you will never land up paying a same rate of interest which prevails on a non-convertible instrument. And if you're convinced on this, then I think I am ready to discuss hybrid instruments with you. I guess let's see more answers coming in. Yes, we got the answer that in this particular case, it is a CFI, and many of you said it is going to be hybrid as well. Great. And Satish said, so Mr. C bears the risk for return portion, the return portion equity, the principal portion FL, and it becomes a CFI. That's great. Wonderful indeed. Okay, now I think I'm ready to do some analysis. The next 5-10 minutes is going to be a bit heavy, and as soon as it gets heavy and gets out of the mind, I'll give you a break at that time. I'm now going to discuss something very technical indeed. And after that, once I'm discussing that, I know your mind will start coming out to things, and I'll give you a break at that time because I'll repeat that things after the break with you. But I think let me now first take you to the add-ons. Now, please watch this analysis very carefully, because if I want to explain you the concept of hybrid contracts, we need to understand something very carefully. We'll do the compound financial instruments detailed analysis later, but for the time being. So we decided one thing, that if there is an optionally convertible instrument, so if there is an optionally convertible instrument which is issued, I think one thing is very clear, that it is going to be a compound financial instrument. And you know with the reason why. Because in this particular case, you can say the contracted rate will definitely be less as compared to the contracted rate on non-convertible instrument. The company will never pay a rate of interest on this convertible instrument which is equal to a non-convertible. They will pay less. So it is bound to be a compound financial instrument. And I said earlier that if it has got an option, the option means it has got a presence of a derivative as well. The presence of option means that it has got a derivative element. And if it is a derivative plus a CFI, this is going to be technically called that it is a hybrid contract. It is going to be called as a hybrid contract. So trust me, when you look at an instrument which is optionally convertible in nature, you will definitely see two important facets. One is that the contracted rate on such an instrument will be lesser as compared to a non-convertible instrument, giving rise to a CFI. And number two, you would see that the option to convert will give rise to a derivative. This is not a pure ND, non-derivative, or a pure D derivative. It's a blend of derivative and non-derivative. Now, I gave you a little insight in the previous class, though I'm yet to discuss more on compound financial instruments. But I told you that a compound financial instrument is segregated in terms of two elements. You'll segregate the financial liability and you will get the balance equity. If you remember, in my last class discussion, I said bank gets a debit with what you receive. And the financial liability gets a credit, which is the present value of the future outflows discounted. And that would be the financial liability element, and you will get the equity as a balancing figure. Out of the total proceeds, you segregate the FL and you get the equity element in terms of CFI. Now, how exactly we do that we are yet to learn, but we are going to segregate the CFI in terms of two elements. And along with this, you can see that there is a derivative as well. Aha. If there is a derivative, we know that this instrument is going to be settled in equity shares. And if it is derivative in nature, you need to apply which test? You know that you're going to apply a fixed for a fixed test. So you're going to apply a fixed for a fixed test. Now, let me first pinpoint one thing, please, very carefully. This FL is the non-derivative element. This CFI is segregated in terms of FL, which is a non-derivative financial liability. And when you apply the fixed for fixed test, it will either pass or it will fail. When you apply the fixed for a fixed test, it may either pass or it will fail. If the fixed for fixed test passes, then this derivative is equity. And if it fails, then it is FL. This is the derivative financial liability. This is a derivative financial liability. And at this stage, let me tell you something very important. If it is a derivative financial liability, you need to segregate this, you need to segregate this, and you need to segregate this. Because the financial liability derivative element in nature has got a different accounting. The non-derivative financial liability has got a different accounting, and the equity has got a different accounting. But if you say that this is equity, we will not segregate this derivative. We'll see this discussion again when we come to the concept of embedded derivative section in financial instruments. Don't get worried on the logic. That logic will be seen later. But what you need to remember, if this derivative fails the fixed for a fixed test and it is a financial liability, you need to segregate three elements of this compound financial instrument. You're going to segregate the non-derivative FL1, you're going to segregate the derivative FL2, and you're going to segregate the equity. Sir, can you give us an example of how this segregation is done? Later. We're going to give you inputs later, but you can see that I would segregate three elements. This is 1, this is 2, and this is 3. If it passes the fixed for fixed test, then we will not segregate. Then we will not segregate the derivative, which is what is called embedded in the instrument. If this instrument, the derivative is meeting an equity element, it is not segregated in this case. Sir, this was too heavy in order to digest things. So I think it's the right time that, we first give you a break and you take your minds relaxed and then we discuss. I'm sure I'm first getting some questions to ask. Okay, and that was right. Fixed for fixed test, that was rightly given. And Prashant, you said, sir, can you tell how the options can be a derivative? Well, if you remember, when we look at any derivative contract, options are always derivative contract. Forwards, futures, options. So if you say that in a particular contract, you insert an option, inserting an option is called a derivative gets embedded in the instrument. Either it's a pure option contract, then it is a pure derivative contract. But in an instrument like debenture, preference share, you insert You insert the element of optionally convertible debenture, optionally convertible preference share. So inserting the option to convert in terms of these instruments would mean that you're putting a derivative. It is called an embedded derivative in the instrument. So in a compound financial instruments, if you introduce options to convert them into ordinary shares, it is like inserting a derivative element. It is called ED, embedded derivative. That's the reason. Okay, and I think I'm getting more questions. Shruti, how can we say if it is non-derivative? Well, the if there is no option to convert, trust me, leaving the remaining instrument is non-derivative. It is only the option is added, it adds a derivative component to the instrument. So we can say the instrument per se will be non-derivative only because of the option to add, it adds a derivative element. So this portion of the CFI is going to be non-derivative in nature, and it is only the option which will become derivative in nature. Okay, and Yadu tells me it's beautifully explained. Thank you. Thank you much. Thank you indeed. And Mancha sir, CR or NC means the market rate. Well, in this case, yes, contracted rate on non-convertible. NC here means non-convertible and CR is the contracted rate. Claire Prashant, okay, that's great. Wonderful indeed. I think it's time now to give you a break. I will consolidate this part once again post the break and we'll take the journey forward. So please make your minds relaxed and we'll begin the journey once again after the break. So it's almost 7:45. Let's give you a 10-12 minutes break and then we commence back, friends. Welcome back, friends. I hope you relax your mind. And I think now let me just quickly take a recap on this instrument, which is called a hybrid instrument in nature, which has got a derivative and a non-derivative both. Okay, I think Shruti, you've got a question. So we need not test a CFI whether it is a derivative or not by the features. Yes, it is only you can say the option to convert, which is a derivative embedded in the instrument. Only that is to be seen whether it has got the options of derivative or not. So once we'll come to the concept of embedded derivative, which is discussed in one of the units in financial instruments. So we'll be coming to that discussion once again. Right now, I'm just giving you that, if there is a hybrid contract, then how many elements do you segregate? So I think let's take a quick recap on this. We'll just make a little fresh chart and let's consolidate the learnings on this. So I'm reminding you back in terms of what I started off. I said that there is an instrument which is a pure non-derivative in nature. I like to now make one thing very clear. So please watch this carefully. Please watch this carefully. Oh, I think I need to change it to a line. So now let's watch this carefully. So I'm now looking at, you can say, three kinds of instruments or three kinds of contracts. Based on our understanding of all the aspects now, I'm looking at three kinds of instruments. Let's say you've got a non-derivative contract. You've got a non-derivative contract or instrument, or you've got a derivative instrument or a contract, or you've got a blended one that's called derivative plus non-derivative. So what we have done so far, except the discussion before the break, trust me, we've seen questions largely non-derivative, and that share warrant question, which I said was supposed to be a derivative. Basically, all the questions which we saw were effectively all non-derivative in nature. So when you say it is a non-derivative contract and the focus is the mode of payment is cash, the mode of payment is cash, well, it doesn't really make a difference to me, whether it's a non-derivative or derivative. So the moment your mode of payment is cash, I'm not even bothered whether it is a derivative or non-derivative. Here the focus is completely whether it is mandatory, whether it is discretionary, whether it is redeemable or it is irredeemable in nature. Simple. That is as simple as that. Now, when the mode of payment turns in terms of equity shares, when the mode of payment turns into equity share, now the focus is definitely important that it is non-derivative. And since it is non-derivative, you need to choose the test. And being a non-derivative in nature, you choose the test that I'm going to apply the fixed test in this case. And accordingly, you decide it is FL or it is equity. So this is one thing. So we did a couple of illustrations on these area when the mode of payment was cash or the mode of payment was equity shares. And we decided if it is equity share, let's focus whether it is a fixed or a variable number. Now, the moment it came to a pure derivative, trust me, in terms of a pure derivative, you can say either it'll be net settled. Either it'll be net settled. I'm just adding a few things now. For example, when you enter into option contract, so there is a possibility that you do a net settlement. The net settlement means that you are going to basically do cash settled. You're going to do basically cash settled. Now here again, if it is supposed to be cash settled in nature, it doesn't make a difference, whether it's derivative or non-derivative, but we know that pure derivative contracts can be settled in terms of cash. And if it is settled in terms of cash, in this space, we will be seeing the accounting later. How does the derivative accounting get handled? But here we were focusing more on that if a derivative is a mode of payment is equity shares, and we took one of the examples out here that it was a case of, let's say, a share warrant. it was, let's say, a case of share warrant, then we said that in this particular case, now we need to see that in this particular case, if it is non-derivative, you need to apply a fixed for a fixed test. You need to apply a fixed for a fixed test and decide. So the moment it is non-derivative, the focus is fixed test. The moment it is derivative in nature, the focus shift from a fixed test to fixed for a fixed. You start looking at the consideration and the number being fixed. Now we entered into a third area of discussion, and we said an instrument which is got derivative and non-derivative is basically called a hybrid contract. It is basically called a hybrid contract, and trust me, generally, I'm using the word generally, when you go to issue optionally convertible instruments, I'm saying generally, when you go to issue optionally convertible instruments, this will become a case of hybrid instruments. Just like a share warrant is a pure derivative, trust me, an optionally convertible instrument would generally be hybrid in nature. So optionally convertible instruments would be hybrid in nature and at the same time generally a CFI. So we said an optionally convertible instruments would be a compound financial instruments along with the option to convert, giving rise to a derivative which is called, it has got embedded derivative in it. Which is called, it has got embedded derivative in it. So mind the words carefully. So the moment a company issues an optionally convertible instrument, so there are two things which will be, triggering off. One is that there is a derivative embedded in the instrument because it is an option to convert. So when there is an option to convert, we say that there is a derivative which is embedded within the instrument. So there is a non-derivative instrument which is a CFI, and there is a derivative which is embedded, included in that instrument. So we've already seen with our prior discussions that a compound financial instruments will be segregated in terms of financial liability and equity components. Though we yet to see in a larger detail, how does a compound financial instrument gets segregated in terms of FL equity? But last class I gave you that financial liability means the present value of your future outflows. So from the total money you receive today on the instrument, you reduce the financial liability, which is the present value of the future outflow, and you segregate FL and the equity. But now what is the addition point to be done? And this segregation of FL is a non-derivative component. This FL, the financial liability which you're segregating, is non-derivative in nature. Now, the only thing to be seen is that this option to convert, which is a derivative, this is to be tested for a fixed for fixed test. This is to be tested for a fixed test. Now, let's put it like clear. If you apply the fixed for a fixed test and it passes, the derivative is equity in nature and the segregation is not required. Why it is not required? We will see that in embedded derivative section. So don't get worried on the logic. So if you say in this particular case that the derivative meets the fixed for fixed test and it turns out to be equity in nature, the standard prohibits, there is no need to segregate the derivative. Why? We'll see the logic later. So if the fixed for fixed test passes, then this derivative is going to be called as equity and there is no need to segregate this. So the moment the derivative is got an equity characteristic because it passes the fixed for a fixed test, the standard prohibits you and says you're not going to segregate the equity portion of this derivative. So the instrument will be segregated in FL equity only. The instrument will be segregated only in two components, the FL and the equity. But the moment you fail the fixed for a fixed test, then this derivative is supposed to be a financial liability component. And then the standard requires you that this financial liability element has to be segregated because this financial liability non-derivative is accounted differently, which you will learn later. and this financial liability derivative is accounted separately, which you're going to see later. How are these accounted for? We'll see. But the moral of the story is that if the derivative passes the fixed for a fixed test, segregation of the derivative out of the instrument is not done. But if it fails the fixed for a fixed test, the derivative element is segregated and the instrument will be divided in three parts. There will be a non-derivative FL1, there will be a derivative FL2, and there will be equity 3. Now you would say, so give me examples of how the segregations into 2 or 3 is done. That we'll see in compound financial instruments. I hope, friends, I am clear with this picture. Pure ND, pure D, and instruments which are hybrid, which includes a derivative embedded in the instruments, and that is the status. I hope I'm clear. Now I'm going to take you to one example. Okay, couple of questions coming in. Shruti said, Tariq said, so in case of optionally convertible instruments, the ND portion, the non-derivative portion of FL, is due to the mismatch of the contracted rate. Well, you can say that, yes. And Shruti said, why equity is not segregated? As I said, that logic will become clear when we come to the embedded derivative. I will not give you the logic at this stage. It's too dangerous to discuss the logic at this stage. That we'll discuss when we come to the discussion on embedded derivatives with you. And then he said, if a CFI is a non-derivative, then we apply 3 features, won't be applied and no test. Well, in order to say that this is derivative, you would have already tested the 3 features. Trust me, yes, of course. I did not explicitly mention that, but if you say the option to convert is supposed to be a derivative, yes, it would definitely fulfill the 3 features, that it is got all the 3 characteristics of a derivative. Very true. And Kirti said, in case of derivatives net settled in cash, there is not any case of combination of derivatives, non-derivative as there is settlement in cash. No. We'll tackle this net settlements later. You know what has been done in the study mat as well? They've done a separate discussions on derivatives accounting and the embedded derivatives of hybrid instruments. So there is a complete discussion of how derivative contracts are accounted for and how the hybrid instruments are accounted for. How does the embedded derivative elements get segregated or not? So there is a huge level of discussions on that. So I'll not get into those details at this stage. When we come to the ED section, we'll see that. Right now, you must be only clear with the fact that instrument is a pure ND or a pure D, or it's a hybrid in nature, and a hybrid instrument contains a derivative. If the derivative meets the fixed for fixed test, the derivative is not segregated. And if it is failing the test, it is segregated. Why it is not segregated? Why is it segregated? That logics are pending. That we'll do in embedded derivative section. Okay, that was quite technical indeed. Now, I just need to bring you back on that illustration which was pending. I said I'll come to that discussion. There was illustration 5, I guess. So let me just take you back on that illustration 5. Optionally convertible, redeemable preference shares. Let's have a look. Let's have a look at this illustration number 5. So as I said, we'll be discussing it shortly. I think it's time now come that we look at the illustration 5 in the unit number 3 of the study mat. Let me read. It says D issues preference shares to G. The holder has got an option to convert. And it says to convert these preference shares to equity instruments at any time up to a period of 10 years. If the option is not exercised, the preference shares are redeemed at the end of 10 years. So the holder has got a complete choice. He'll tell me after 10 years, I want shares, I want cash. I know, friends. Now you must be thinking. So I think let me give you a basic answer. You would tell me, sir, how is the accounting for an instrument done when it is mandatorily convertible, when it is optionally convertible, when it is partially convertible, when it is perpetual, irredeemable in nature? That's my next area of discussion. Tomorrow, we will be discussing in detail, though I'll trigger certain thoughts today, but tomorrow I will give you the entire accounting treatment of compound financial instruments, understanding how the accounting for OCD, optionally convertible debenture, then PCD, partially convertible debenture, MCD, mandatorily convertible debenture. How is it done? So what is the accounting if these instruments become compound in nature? How does the accounting for optionally convertible, partially convertible, and it has been mandatorily convertible done? I'll also give you the treatment of a perpetual loan, which is classified as a CFI. We'll do the entire detailed accounting of these instruments. And I'll then give you a wonderful chart on all the permutation combinations on that. So tomorrow you'll get a complete feel of how these kind of instruments are accounted. Right now, don't apply your mind in terms of how the accounting is done. Right now, we're just focusing on the presentation. That what are the various components which are included in this instrument, which needs to be presented separately in the balance sheet of the company. How the accounting is done is going to be a second agenda. Okay, so right now it says the holder has got an option to convert. So let me ask you, if it is an option to convert, can I safely assume that it is a CFI on the ground that the contracted rate would be lesser as compared to the rate on a non-convertible instrument? And can I also safely assume that since it is optionally convertible, therefore there is a derivative embedded in the instrument? Can I safely consider that it is hybrid in nature? Sir, आपने तो एक ही सांस में सब कुछ कह दिया. But I think let's get the inputs on your side. Did I say correct? Did I say correct in this case that considering it is optionally convertible in nature, my mind is telling me thought one. The contracted rate is below the rate on a non-convertible instrument for sure, leading to a CFI. Optionally convertible means there is a derivative embedded and therefore it is hybrid in nature. Vouch me. So it says the instrument has got two components. So one is a contractual obligation that is conditional on the holder exercising the right to redeem or a conversion option. The first component is a financial liability because the entity does not have the unconditional right to avoid delivering cash. In any case, as an issuer, the person says, give me cash, I'll have to give cash. He says share, I'll have to give share. So I have an unavoidable obligation to pay cash. Since I've got an unavoidable obligation to pay cash, the contractual obligation to redeem is undoubtedly FM. Then he says rest of the discussions we'll do when we come to the compound financial instruments case. Correct? Yes, that's rightly agreed. Okay. Now I think let's do some lighter things, because I think today I've done a huge technical level of things as well. Don't worry, financial instruments is very interesting. So at places you'll see some technical things happening, but they're very interesting at the same time. So let's do some easy part right now, and then we'll do more discussions with you. If I just come back on the agenda from where I started off the standard, we understood that there is a financial liability. We understood that there is a financial liability. It still becomes an FA for the holder. It's an equity instrument. It still becomes an FA for the holder. Or even if it is a compound financial instrument, it still becomes a financial asset for the holder. But we've neither seen a definition of financial asset. I did not touch upon the definition. My focus has been only on the issuer, telling you FL, telling you equity instrument, but I never made a walkthrough on financial assets. So I think now I am going to, for a little change, talk about financial assets as well. So let's now focus on the financial assets. Let's first focus on financial assets. And let me tell you a few things in terms of financial assets. If you look at the definition of financial asset, it says financial asset is cash. Cash is the medium of exchange. So we can say that if there is a cash, it is undoubtedly financial asset. Similarly, it says that there is investment in equity instruments. There is investment in equity shares, which is also a financial asset. Now, at this stage, I'd like to draw your attention, which is very important because I don't want that later it creates any kind of confusion. I think I made that discussion earlier as well, but I'd like to now remind you, investment in equity shares. I think I did the discussions when I came to Ind AS 27 as well, but I like to remind you back again at this stage in financial instruments. Investment in equity shares can be related party or it can be unrelated party. The definition itself says, if you look at the definition of financial asset, it says it is cash, it is investment in equity share. So one thing is very clear, that investment in equity share is undoubtedly a financial asset. But we are adding something based on the scope reading. So if you've got investment in equity shares in a related party means it could be in a subsidiary company, or it could be in an associate, or it could be in terms of a joint venture. The standard scopes out this investment from the scope of the standard. If you look at the scope of Ind AS 32 or the scope of Ind AS 109, it says this is scoped out of. It is scoped out of the standard. The standard is not applicable. So if you've got investment in equity shares in related party, it is not covered under the financial instrument standard. It is a financial asset, but it is still not covered under the purview of the standard. Now, the clarification given is that this is going to be accounted under Ind AS 27. This is going to be accounted under Ind AS 27. So these investments are accounted under 27 and not 109. And Ind AS 27 says that you got a choice of considering a cost model or you can consider a fair value model. So if you consider a cost model, then you will account them at historical cost. So if you're going to consider them at a cost model, you're going to account them at a historical cost model. And if you're going to consider a fair value, then you come back to the financial instrument standard. So the standard on financial instruments throws them out. It says standard not applicable, and then it goes to 27, and it still gives you a choice. You want to go back, you can. Though practically no company would ever consider an investment in a related party at a fair value. But if you choose a fair value theoretically, then you're back to the financial instrument standard. So per se, if you're going to say that there is investment in equity instruments, I'm going to put across a question, is it in a related party? And if it is a related party, per se, Ind AS 27, therefore the financial instrument standard does not apply. Unless the company specifically chooses to apply a fair value, then you are back to financial instrument standard. If it is an unrelated party, I am definitely scoped in. I'm definitely scoped in this particular standard. And further, believe me, the rest of the definition is nothing but it's a mirror image. It is nothing but it is a mirror image of financial liability concept. So these are the only two additional clauses which are given in the definition, that financial asset is a cash. Financial asset is investment in equity shares. And the rest of the definition is exactly a mirror image, which means you're looking at a contractual right to receive cash. You're looking at a contractual right in maybe settled in terms of equity shares. It is exactly a mirror image of whatever you've done in terms of financial liability. Okay, now I think it's testing time. Let me also now ask you, if there is a contractual right to receive, should you get the payment in terms of cash or equity shares only? Any other mode of payment will not be considered? Yes. So if you say that you do not get a contractual right to receive, in those cases, the asset cannot be financial. One. If you say that there is no contractual right to receive, but there are two kinds of assets. One is an asset which is creating an opportunity to receive. That's non-financial. And one is the asset which creates a right, contractual right to receive. So we can say if there is a no contractual right, but opportunity is created, it is non-financial. And even if there is a contractual right to receive, but that contractual right would be in terms of goods and service, then also it is non-financial in nature. Let's, I think, apply this to a simple little illustration in the study mat. Let's take it further. Okay, I think Preeti, you said so investing in unrelated party means a passive investor. Yes. When you're looking at unrelated party, undoubtedly you're right. It is called a passive investor, in which generally you've got less than 20% shares in a company. If I go with a rule-based concept, then we can say if you've got below 20% stake in a company, it is called a passive investment. Okay. So now let's go back to the study material, and we want to have a look at a few inputs out here. So let's have a look at a few inputs out here. So this is something which we need to discuss. Okay, it starts from here, example 1. So this is example number 1 on financial assets. Just as we discussed financial liabilities, I thought we'll just quickly have a look at financial assets as well, so that at least FA, FL, EI is clear. The terminology gets cleared, and then we can take it further. Okay, let's begin. It says investment. It says investments in bonds and debenture. Does it create a contractual right to receive? Yes. And I would assume that the contractual right is to receive in cash. So we can say there is, number 1, a contractual right, and that would be to receive cash. Then it says loans and receivables, same logic. It is FA. Deposits given, same logic. Trades and other receivable, same logic. So all these are financial assets because they would meet the two basic features. They give you a contractual right to receive, one, and if nothing is given, the mode of receipt is cash. Since the mode of receipt is going to be cash, in this case, we can say undoubtedly it becomes a case where you can say it is FA. Then he says cash and cash equivalents. It is specifically mentioned in the definition. As I said, if you're looking at cash and cash equivalents or investment in equity share, it is something which is specifically stated in the definition. Then he says there is a bank balance. Even a bank balance would create a contractual right to receive money from the bank. So it would be again considered as a financial asset. Right, so these are very simple examples. Now let's have a look further on more examples. Let's have a look further on more examples out here. Now watch this in terms of the further inputs given. Now it says investment in equity shares. It says investment in equity shares. Now this is also specifically given in the definition itself. But I think now you know a little more detail that if it is unrelated party, no, scoped out. If it is a related party, yes, it is scoped in. So this is equity instruments of another. This is also given in the definition. Now come some interesting inputs out here. So first of all, we are given there is a perpetual debt instruments, a company invested in a perpetual debt instruments. If a company issues a perpetual debt, it is FL. So as a holder, it is definitely a financial asset for me. Whether it is FL or whether it is CFI for the issuer, it is undoubtedly a financial asset for the holder. So such instruments will give you a contractual right to receive interest for an indefinite future, or a right of principal under terms which is very unlikely or very far in the future. So as I said, the standard considers that perpetual debt is, the principal is getting auto-renewed. So in any case, even a perpetual debt instruments will definitely be considered as a financial asset in nature. Then comes the tangible assets. Then comes the intangible assets. Then comes the leased assets. When you look at the physical assets, tangible assets like PPE, like investment property, like inventory, do they create a contractual right to receive money? No. They create an opportunity to receive money. So all these tangible, intangible assets like inventories, property, plant, equipment, intangibles like patents and trademarks or leased assets, they are going to give you a right to receive. They do not create a right to receive cash. None of them is supposed to be a financial asset. The property, plant, equipment, the investment property, you can say the biological assets, all these assets are going to create an opportunity to generate revenue. So they are non-financial in nature. They're not financial assets. They're non-financial in nature. Similarly, we are given there is a prepaid expense. And when there is a prepaid expense that you paid some money, now you will be getting some goods and service in return. The mode of receipt is not going to be in terms of cash or equity shares. So in this case, you will be getting the economic benefit in the form of goods and services. Therefore, they would also not be financial assets in nature. So moral of the story is any assets which will not give a contractual right to receive, but opportunity to generate a non-financial. Any assets which may give you a contractual right to receive, but receipt is in terms of goods and service and not cash, are again non-financial in nature. So assets which are creating an opportunity to generate are non-financial. Assets which are giving a contractual right, but the mode of receipt is goods and service, are again non-financial in nature. The advance which is given for goods and services, the name itself is that you're given an advance, and where the mode of receipt is again going to be goods and services. Since it is going to be goods and services, it is not financial in nature. So that was just a clarification in terms of the financial asset definition and the basic examples that which kind of assets are going to be financial in nature. But trust me, even if you start looking into the balance sheet schedule 3, you will clearly see in the balance sheet format in schedule 3 which assets are financial and which are non-financial in nature. The assets have been segregated in terms of non-current and current, and then the further segregation in terms of financial and non-financial is given. So very clearly you can see all those examples of assets which are financial, your debtors, your investments, they're typically financial in nature. All other assets other than financial, your PPE, investment property, intangibles, biological assets, they're all supposed to be non-financial in nature. Right, friends, I think so far so good. I think that was pretty easy indeed. So that was on a lighter side. Okay. Now this part is done. Now let's go further. And now there is this part, liability we have done. Perpetual debt instruments is done. Now there is a small little input which I think I'll just like to run through an example. Then we can go to the further discussions. Now there is another small little illustration in the study material. And this is again in unit number 1, and there is illustration 5. So with all this, you'll be able to manage a couple of illustrations in unit 1 as well as unit 3. Unit 2 is pending because unit 2 is Ind AS 109. We are still on Ind AS 32. Our focus has been still on Ind AS 32. We're looking at, classifying the instruments into various categories. Okay. Now there is a typical illustration which is given in the study material, and I think I'll just like to make a quick walkthrough on that illustration so that we get a little clarity of thought. It says in illustration 5, a company A Limited makes a borrowing of 10 lakhs from RBC Bank with a bullet repayment of 10 lakh. A bullet repayment means that you're going to make a principal, a lump sum payment at the end. A bullet payment is called a lump sum payment at the end. It says with a bullet payment of 10 lakhs and an annual interest rate of 12% per annum. The company defaults at the end of 5th year, and consequently a rescheduling of the payment schedule is made beginning of the 6th year onwards. Then he says the company is required to pay a 13 lakh rupees at the end of 6th year as a one-time settlement in lieu of the defaults of the payments made earlier. This illustration I am doing to also give you another interesting clarification. If there is a financial liability, we made the stand. Please hear me very carefully. If there is a financial liability, the mode of payment is cash, or the mode of payment is either equity share, variable in number. But let's say a financial liability is settled by another financial liability. Would that also be considered as a financial liability? Yes. So in terms of a financial liability where a loan is rescheduled and you just change the terms and it leads to a different amount of a financial liability, it still retains the characteristic of a financial liability. So in this particular case, I am given that you took a loan and you're going to pay 12% per annum with a bullet repayment at the end of 5th year, but we made a default and a reschedulement was done at the beginning of the 6th year. The company is required to pay 13 lakhs at the end of the 6th year for one-time settlement. Does the above instrument meet the definition of FL? Please explain. Analyze the differential amount to be exchanged for one-time settlement. It's pretty logical. So this, I think, came in the exams as well. A Limited entered into an arrangement where against the borrowing, A has got a contractual obligation to make a stream of payments, interest and principal. So therefore, definitely it meets the definition of FL. I guess we can say there is a contractual obligation. Yes. The mode of payment is cash. Yes. And it seems to be unavoidable mandatory payments. Yes. So it is undoubtedly a financial liability. Now, we need to compute the differential amount to be exchanged. Now, we know the principal amount was 10 lakh. And we want to calculate what was the liability outstanding at the end of the 6th year. So if you're looking at the liability outstanding at the end of the 6th year, we are given that this 10 lakh is compounded. You can see at the 12% rate of interest. We are compounding 10 lakhs for 12%. Why? He says we committed a default at the end of 5th year. When you committed a default, that means the interest for the 5th year was not paid. And then there was a rescheduling done and it was done at the end of 6th year. So you are overdue to pay interest for 5th year. You're overdue to pay interest for the 6th year. So what we have done a compounding at the rate of 12% for the non-payment of the 5th year and for the non-payment of interest for the 6th year. So 10 lakh rupees compounded for the interest overdue for the 5th and the 6th year. So this is the amount of liability at the end of the 6th year, the principal with interest for 5th year and 6th year put together. We made a payment of 13 lakhs at the end of 6th year as per the instructions given in the question. So this is the difference which is there. So what is the difference to be exchanged? This 45,600, the additional amount which you're liable to pay on exchange of, you can say, a financial liability against another financial liability is also a financial liability. So this amount is also going to be called as a financial liability. So it says very clearly, okay, no, that was different. Okay, that is done. That is done. So that was a simple little question now. Now I have another focus area of discussion. Definitions done, but one major issue is now pending for discussion. So we've got the next almost 20 minutes to go. And in the next 20 minutes, I've got something more interesting to discuss. I know your minds must be getting a bit heavy indeed, but you need to bear me for another 20 minutes for a last area of discussion so that all the definition sections is taken care. And we are now going to discuss the carve out. So we are now going to discuss the carve out in terms of the definition where the IFRS and the Ind AS differs. And there is a discussion and there is an illustration which is given on the agenda, and you need to watch this very carefully. So this is going to be a last phase of discussion which might be slightly heavy, so bear with me. I'm now going to take you to the last area of my discussion for the day, which is based on the concept of carve out. Let me just share the discussion page, which is given in the unit number 3. And let's have a look at the inputs in terms of this. Right, so this is the agenda, and I think let's have a look at this. This is our last area of discussion, and let's have a look. Now, please hear me carefully, because this is what I'm going to tell you is going to be looking slightly technical, and just hear me very, very carefully. We'll make a summary notes after the end of the discussion, but first have a look. We are looking at the concept of carve out from IFRS. You already know that areas where IFRS and Ind AS differs is called a carve out. So where the IFRS says a particular treatment, but the Ind AS disagrees, and that is called a carve out. So there has been a difference in terms of, financial instruments area as well. Let's see what is that. It says equity conversion option embedded in a foreign currency convertible bond. We can call this as FCCB. We can call this as FCCB, foreign currency convertible bond. The standard says equity conversion option, which is embedded in a foreign currency convertible bond. Now see what the standard says. Ind AS 32 considers that equity conversion option, which is embedded in an FCCB denominated in a foreign currency, to acquire a fixed number of equity instruments as an equity instruments if the exercise price is fixed in any currency. So we did not understand this. We did not understand this. What do you mean by that FCCB, a convertible option to acquire a fixed number of equity instrument if the exercise price is fixed in any currency? I'll explain. Let's, I think, first take you to what IFRS says. As per the accounting treatment under IAS 32, equity conversion option of a foreign currency FCCB is considered as a derivative liability which is embedded in the bond. Gains or losses arising on account of change in the fair value of this derivative needs to be recognized in the statement of P&L. So we did not understand. I think let me now take you and give you an insight. I did my discussions on hybrid instrument because I wanted to ultimately take you to the carve-out decisions as well. Now, watch this carefully. We're looking at FCCB, foreign currency convertible bonds, which has got a equity conversion option. Please hear every word carefully. So we are saying that there is a foreign currency convertible bond and it has got a equity conversion option. Option, thy name, derivative. Option, thy name, derivative. Now, if you're saying that this is an option, then I would say, okay, let me say that this is a derivative. And if it is a derivative, you're going to settle this in terms of equity shares. A company issued a foreign currency convertible bond, which has got an option to convert into equity shares. Now, since it has got an option to convert into equity share, it is a derivative to be settled in terms of equity, and therefore you need to apply the fixed for a fixed test. Correct? Please mind every word of what I say. So in this particular case, since it is a derivative, you need to apply the fixed for a fixed test. Now, when you go to apply a fixed for a fixed test, there are two elements to be seen. One is the consideration, and one is the number. So one is the consideration and one is the number. Now, what does the position under IFRS says? If you've issued a foreign currency convertible bond, if you've issued a foreign currency convertible bond where you tell the holder, I will give you fixed number of shares. I'll give you a fixed number of shares, and this will be given for a fixed exercise price. For a fixed exercise price. Mind the words carefully. The international standard says when you're telling the fellow, I'll give you fixed number of shares at a fixed exercise price. The exercise price is fixed in foreign currency. But do you think that it will be fixed in terms of functional currency, or will it fluctuate and it will become variable because of the exchange rate between the functional and the foreign currency? So which means it is fixed exercise price. If you look at in terms of foreign currency, you can say it is fixed. But if you say that it is supposed to be, in a functional currency, if you see that it is an exercise price in a functional currency, then you can say it is going to be variable in nature. It is going to be variable in nature. So the question now arises that if I say that the number is fixed and the consideration in the functional price is variable. I know what I'm saying is very technical. You might have to sit down and watch this portion once again. Do it. So we can say that the number in this case is fixed, but the consideration in functional currency is not fixed. Because the exercise price is fixed in a foreign currency, but when you translate that in terms of functional currency, the consideration will become variable. And if this is fixed and this is variable, that means it should be treated as a financial liability. And if it is to be treated as a financial liability, the IFRS says that it is a derivative FL. So they say that this conversion option as per IS 32 is a derivative FL. And trust me, we're going to see later that derivative FL is supposed to be measured at fair value through profit and loss account. So the financial liability, which is derivative in nature, will be measured at M to M, mark-to-market margin, where you will consider the concept of fair value through profit and loss. The Indian position didn't agree with this. In India, we said, no, boss, we don't agree with this. And we said that, yes, the number is fixed. But we are going to see that if you fix the exercise price and it is fixed in any currency, I don't care. I will not see whether it is fixed in foreign or it is fixed in functional. You fix it in any currency, I will consider it to be fixed in nature. And if you go with the fact that it is fixed both the ways, number is fixed and the currency is fixed, any currency, then it is called equity in nature. If it is going to be equity in nature, then in this particular case, FPTPL will not apply. And if FVTPL will not apply because equity is not taken at FVTPL, not at a fair value through P&L. So I will not have to book any changes in the profit and loss account because we thought that if you're going to consider this as a financial liability measured at FVTPL, the fair value changes captured in the P&L will increase the volatility in terms of profit and loss. And we decided that why should we get emotional out here and consider that the excise price is fixed in foreign, but it is not fixed in functional. Why should the rate of exchange, interpret that the fixed has become variable in nature? So the international standard board and the Indian position was different. See what was the reasoning given. Whatever I've told you, see what was the reasoning given out here. So we'll look at the reasoning in terms of what is given by the accounting standard board. See what it says. This treatment as per IS2 is not appropriate, such as FCCB, since the number of shares convertible on exercise of the option remains fixed, and the amount at which the option is to be exercised in terms of foreign currency is also fixed. Merely the difference in the currency should not affect the nature of the derivative. You're going to look at the consideration in a foreign currency, it is fixed. You're going to look at a consideration in a functional currency, it will become variable. And then you will say the fixed for fixed test fails. And then you will say that it is a derivative FL. Further, the fair value of the option is based on the fair value of the share price of the company, because the value of the option is a derivative and it derives its value from the share price. If there is a decrease in the share price, the fair value of a derivative liability will also decrease, which will result in recognition of gain in the P&L. But the problem is that if the fair value of the share goes down, the person will not exercise the conversion option. If the fair value of the share goes down, the other fellow will not even exercise the option. And if he is not exercising the option, why should I consider the fair value changes of that liability in my P&L and disturb my profit and loss? This will bring unintended volatility in the statement of P&L. This will also not give a true and fair view of the liability. That when the share price will fall, the option will not be exercised. Begani shadi mein Abdullah kyun diwana ho? If the fair value of the share goes down, the fair value of the option goes down, and I start recognizing the fair value decline in my profit and loss, number one. And at the top of the point, I know that if the fair value of the share is going down, the other person will not even exercise the option. So it says, however, it has been considered that if such option is taken at equity, fair value changes will not be required. Accordingly, the exception has been made. So the basic point was that we wanted to look at differently. So if there is an equity conversion option in FCCB and you're applying a fixed for a fixed test based on IFRS and based on Ind AS, the position is different. So when you look at the IFRS, you say, I'm going to issue fixed share. Okay. But the exercise price is fixed in foreign currency. No, I want to see that it is fixed in functional. It is not fixed in functional. So it fails the fixed for a fixed test. It becomes FL. But in India, I said, boss, please don't go with this treatment. Because in this particular case, when the fair value of the option goes down, the other fellow will not even exercise the option to convert. So why should I take unintended volatility in my P&L? So I said, if the number is fixed, one, and the exercise price is fixed in foreign currency, any currency, you fix it in any currency. The fixed for fixed test is passed. It becomes equity. I will not consider FPTPL approach. No unintended volatility to be taken to my profit and loss. So we decided to create a carve-out. So the IFRS position is fixed number, but consideration is not fixed because it varies in function. In Ind AS, we said fixed number, but the consideration is fixed. Be it any currency, fixed for fixed estimate, it is equity in nature. So let's have a look at a small little example further out here to make it more clear. Let's have a look at the example. Illustration number 24, it says A issues a bond with a face value $100 and carrying a fixed coupon rate of 6%. Each bond is convertible into 1,000 equity shares. Examine the nature of the financial instrument. Now, in this particular case, the company issued a bond which is convertible in terms of equity shares. I'm going to give a fixed number of equity shares and nothing is given in the question as far as the exchange price is concerned. I don't care. Because when you're going to convert this, the exercise price is fixed in functional currency, in foreign currency. If it is fixed, and therefore it will be considered as an equity instrument in this case. So this was the carve out in terms of things. Now, I think, let me just quickly add on the points what we have learned so far. In my journey so far, in the previous and in the current class, I have given you basically a couple of things. Now, in short, I have given you a three-step model. And now when you apply a three-step model, your focus points need to be very clear. And one is, there is a contractual obligation. One. If the mode of payment is cash, your focus point is derivative or non-derivative. It doesn't make a difference to me, but it is mandatory, discretionary, redeemable, irredeemable. If the mode of payment is equity shares, you need to apply the three features and decide, is it derivative or non-derivative? Apply the three features to decide. And then you need to decide fixed test or a fixed for a fixed test in order to decide the nature of the instrument. I've also given you the inputs in terms of financial asset definition as well. And I've also given you the carve out as well. So we have covered three aspects, the three-step model, that is one, the financial asset definitions, clarifications in terms of investment in equity, clarifications in terms of assets, which gives opportunity to generate, or you're going to get right to receive in goods and service, non-financial, and we've understood the carve-out as well. Now, tomorrow, what I'm going to do, I'm going to add our discussions and we're going to focus on compound financial instruments. We're just going to focus on CFI because I need to give you a deeper accounting, how the compound financial instruments are accounted for from the initial recognition to the subsequent accounting. How does the accounting take place? So tomorrow, the entire devotion is going to be on practicals related to CFI. Right, friends. So I think, let me see if any questions further coming in. Yes. Prashant, sir, you said that in consolidated financials, there is a full-fledged question on GFRS paper. Please, sir, can you tell where we can find that question? I think, if I am not wrong, I think if you get hold of the study module on GFRS, which was there, I think it is out of the initial illustrations, maybe out of the first 5 itself. I don't exactly remember the number, but the moment you're going to open the GFRS case study module, you're going to see, I think it's the initial 3-4 case studies itself. So you can get that once you open the GFRS study module. Right, friends. So I think that seems to be good. If you've got more questions to ask me. But now what do you need to do? You need to do a cumulative revision. So what do you need to do? You need to revise the concept in the previous class and in the current class. And then we go to the next tomorrow on the concept on compound financial instruments with you. Okay, so far so good. I think there are no further questions coming in, I guess. Let me just wait for a second. I know your mind must be very tired indeed, looking at the complexities of discussion. But don't worry, tomorrow is going to be a little lighter day. I've done some heavy discussions today, so tomorrow is going to be a little lighter day as compared to today. Today the Shani was a little bhari, I guess. Thank you, Kriti. Thank you so much. Thank you, Prashant. Thank you, all of you, indeed, friends. So I think it's time to bid goodbye, friends, to you. See you tomorrow. Thank you. Bye bye, and take care.